We talk a lot about saving money, cutting expenses, budgeting smarter, finding better deals. And that's powerful. But today, we're taking the next step. Because saving alone is not enough. If you have money sitting in your bank account right now, quietly losing value to inflation, it's time to shift from protecting your money to growing it. In 2026, financial freedom isn't about hustle culture or extreme risk. It's about strategy. It's about understanding how money works and making it work for you. This is your beginner-friendly guide to investing, explained clearly, confidently, and without the Wall Street noise. You do not need to be an expert. You need a plan. Let's start with a mindset shift. Investing is not gambling. It's not day trading. It's not staring at stock charts all day. Investing is simply buying assets that have the potential to grow in value over time. It's choosing to become an owner instead of just a consumer. When you leave money in cash long-term, inflation slowly reduces its purchasing power. Considering how groceries, rent, and travel get more expensive every year, your money buys less if it doesn't grow. Investing is how you protect yourself from that silent erosion. It's how you make sure your future self can afford the lifestyle you're working so hard for today. And then there's compound growth, the quiet superpower of investing. Compound growth means you earn returns not only on the money you invest, but also on the returns that money generates. It's growth on top of growth. In the beginning, it feels slow, but over time, it accelerates. The earlier you start, the more time does the heavy lifting for you. You don't need to invest huge amounts. You need consistency and patience. Now, I know many women hesitate here. Investing can feel intimidating. The language sounds technical. The industry often feels male-dominated. But here's the truth. You do not need to pick winning stocks to build wealth. In fact, trying to guess the next big company is one of the fastest ways beginners get discouraged. Instead, we focus on simplicity and diversification. One of the easiest and most powerful tools available to beginner investors is the index fund. An index fund is simply a basket of many companies bundled together. When you invest in one, you're not betting on a single business. You're spreading your money across hundreds or even thousands of companies at once. For example, funds that track the S&P 500 allow you to own a small piece of 500 of the largest companies in the United States. Instead of asking which company will win, you're saying, I believe the overall economy will grow over time. Historically, broad markets have trended upward over long periods, even though they fluctuate in the short term. This strategy removes pressure. You don't need to monitor headlines every hour. You don't need insider knowledge. You invest consistently, you stay diversified, and you allow time to work. Before you invest a single dollar, though, we need to talk about your foundation. Financial empowerment starts with stability. First, check for high-interest debt. If you're carrying credit card debt at 20% interest, paying that off gives you an immediate, guaranteed return. There are very few investments that can reliably outperform high-interest debt. Clearing it first strengthens your financial base. Second, build an emergency fund. Ideally, you want 3 to 6 months of essential living expenses saved in cash. This isn't for vacations or shopping. It's for unexpected events, job loss, medical bills, urgent repairs. Why is this important? Because investing works best when you're not forced to withdraw money at the wrong time. Markets fluctuate. If you need cash during a downturn, you could lock in losses. An emergency fund protects your investments from your life's surprises. Once those two pieces are in place, you're ready, and here's something empowering. You don't need thousands to begin. Many platforms allow you to start with very small amounts. Investing is more about habit than size. It's about creating a system where you consistently invest monthly, bi-weekly, or however your income flows. Automation is your best friend here. When investing becomes automatic, emotion steps aside. Now let's talk about mindset, because this is where most people struggle. Markets go up and down. That is normal. Volatility is not a sign that investing is broken. It's part of the process. The biggest mistake beginners make is reacting emotionally. When markets rise, they feel confident and want to invest more. When markets fall, they panic and want to sell. But a temporary drop only becomes a permanent loss if you sell. Historically, markets have recovered from downturns, sometimes quickly, sometimes slowly, but patience has consistently rewarded disciplined investors. Think of investing like planting a tree. You don't plant it today and expect shade tomorrow. You water it. You give it sunlight. You allow seasons to pass. Some years it grows slowly, some years it grows faster. But if you keep digging it up to check the roots, it will never thrive. Time in the market matters more than timing the market. Waiting for the perfect moment often leads to waiting forever. The goal is not perfection, it's participation. As you grow more confident, you may choose to diversify further. A simple approach many investors use includes three core categories: broad market funds for stability, growth-focused funds for higher potential upside, and dividend-focused funds for income generation. Broad market funds aim to capture overall economic growth. Growth funds focus on companies expected to expand faster than average, which can bring higher returns but also higher volatility. Dividend funds invest in companies that regularly distribute part of their profits to shareholders, creating a stream of passive income. There is no one-size-fits-all mix. Your allocation depends on your age, goals, and risk tolerance. If you're younger and investing for retirement decades away, you might lean more toward growth. If you value stability or are closer to needing the money, you might prioritize broader or income-focused funds. The key is alignment with your timeline. And we can't ignore taxes. Taxes impact your returns more than most beginners realize. In many countries, investments held longer than 1 year qualify for lower long-term capital gains taxes compared to short-term trades. This rewards patience. Constant buying and selling not only increases stress, it can increase your tax bill. Also consider tax-advantaged accounts available in your country, such as retirement accounts that allow investments to grow tax-deferred or tax-free. Using these accounts strategically can significantly increase your long-term wealth. But let's zoom out for a moment. Investing is not just about retirement numbers on a screen, it's about choices. It's about knowing you're not dependent on one paycheck. It's about building options, whether that's taking a career break, starting a business, traveling, supporting your family, or simply feeling secure. Financial literacy is a form of self-respect. When you understand investing, you remove fear. You stop outsourcing every money decision. You become the CEO of your own financial life. And remember, investing doesn't replace investing in yourself. Increasing your skills, negotiating your salary, building additional income streams, these amplify your ability to invest. Higher income plus disciplined investing is a powerful combination. If you're just starting, don't overwhelm yourself. Open the account. Start small. Automate contributions. Choose diversified funds. Review your plan once or twice a year, not daily. Let consistency do the work. In 2026, the women who thrive financially won't necessarily be the ones taking extreme risks. They'll be the ones who built steady systems, who understood compound growth, who avoided emotional decisions, who stayed patient. You don't need to know everything today. You need to begin. Investing isn't about following trends or reacting to headlines. It's about creating long-term stability and designing a future where you have options. If you found this helpful, subscribe for more money moves made simple. See you in the next one.